All right. Hi, everyone. Welcome to the Timing Research Show for April 13th, 2015. Today we'll be talking about the 81st weekly reports from Timing Research. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports. And my name is David. I'm the creator of Timing Research, and I have Dave Landry guest hosting for me again today. So I'm going to go ahead and turn it over to Dave.
Okay, thank you, David Cosmitter, and thank you to TimingResearch.com for having me here again. Looks like we got a full lineup again today. Matthew, let's start with you. Tell us a little bit about your trading. Matthew Buckley of TopGunOptions.com. Tell us about your trading, and tell us a little bit about TopGunOptions.com.
You bet, man. Thanks for having me. I appreciate it. My name's Matthew Buckley. My call sign's Wiz. That's obviously not my God-given name. My parents did, in fact, like me. I flew the F-18 Hornet for the United States Navy for about 15 years.
Cool.
Graduated from the Navy Fighter Weapons School, which many of you know as Top Gun, hence my very small marketing department as far as names go, and flew 44 combat sorties over Iraq. But as a young junior officer in the Navy, yeah, it was a good time, Ed. But as a young junior officer in the Navy, oh, you're welcome, man. It was a good time. Yeah, exactly. I taught myself how to trade equity options, and I learned everything, or I applied everything that I was learning flying the F-18. You know, being disciplined, managing risk, knowing the difference between a strategy and a tactic, knowing when to get out of a bad situation and not make an emotional decision, but one based on events and data that you're seeing.
Wow.
So I applied that to my options trading, and it worked really well. So I've been trading options for over about 20 years. It worked so well, in fact, that I popped up on the radar of one of the largest volatility arbitrage firms in the country, Peak 6 Investments, headquartered right there in the Chicago Board of Trade, and ended up being their managing director of strategy for about three and a half years, and decided that Chicago winners were best left for people other than me, and decided to move down to Boca Raton, Florida, where I started Top Gun Options about 5 years ago. So that's the genesis of Top Gun Options, and we teach people of all skill levels to trade equity options. Because if the Navy can take somebody who's never even seen an airplane before, and in a short amount of time, get them flying off the pointy end of an aircraft carrier over bad guy country. I apply those same methodologies to training options traders as well. So that's a little bit about me, and then TGO. Thanks for having me.
Cool. Is that your maid in the background?
Yeah, I know. She would beat me if you said that. If I said that, yeah.
No, it looks like you're in a hotel room. That's why the reason I'm saying that.
Yeah, I'm actually up here in New York, and I was up in Canada last week doing some speaking, and New York today, and then flying back to Miami tonight.
Oh, cool. When you went to Top Gun school, was that in Pensacola, Florida?
No, that's where you go through initial flight training in Pensacola, Florida. Top Gun was in San Diego and Miramar, and now it's up in Fallon Naval Air Station up in Nevada. So they put it out in the middle of the desert, so we behave.
Cool. Okay. Yeah, I know somebody from Pensacola that I don't know if you guys are probably separated by a little time, but we'll talk offline on that.
Bet.
But what a heck of an intro! Wow. All right, we got friend of the show. Well, hang on first. Let's go to Norm. Norm's actually new to the show. Norm Winski. Norm, tell us a little bit about yourself and tell us a little bit about your trading.
Great. Thanks for introducing me there, Dave. I'm a former Chicago floor trader. I started out right out of college back in the 70s. I went right to the CBOE. I was a market maker for 12 years. Also traded on the Board of Trade when they were back in the 80s when they were trying to develop the index futures. And all this time, I had a lifelong interest in cycles and advanced technical analysis. I studied Elliott wave, Gann. Gann was into the planetary cycles. I do that, and Fibonacci, Lucas numbers, fractals, all those sort of advanced technical analysis approach.
Wow.
So I've been studying the markets actually since I was 15, and I'm 64 now.
Wow.
So I'm getting close to 50 years.
You know, one thing a floor guy told me, or actually it was a floor girl, she said, you look to your left, you look to your right, and you wait a couple of months, And if those same two people are still there, then you kind of hang out with them because they know what they're doing. So anyone with floor experience has my respect.
That's true. I saw a lot of turmoil over there, a lot of turnover there.
Cool
Speaking of,
stuff.
speaking of looking to my left and to my right, and you mentioned a girl. I remember right behind me in the crowd right behind me there was for a while there. We had a former Playboy playmate, market maker.
Oh my goodness, was it? That must have been hard to focus, unless she was from like 1930.
And I just kept my back. I kept my back turned because given the choice between money and the other, probably going to go with the money, right?
Well, it sounds like you got some good stories too. Maybe we'll have to get together offline later on too. Next up, we have a friend of the show, Steve Place of InvestingWithOptions.com. Steve, tell us a little bit about yourself and tell us a little bit about InvestingWithOptions.com.
Sure, Dave. Thanks for having me. My name is Stephen Place. I'm the founder and head trader of InvestingWithOptions.com. We specialize in trading options, specifically stock options. My trading style is basically two kinds of trading. The first kind is directional trading, where we're looking to make money based off of directional moves in individual stocks and markets. And then the other kind is income trading, which is more statistically based. Trading looking to profit when a market doesn't see any kind of movement. They pair off very well. I started investing with options about 6 years ago. I'm a recovering engineer, as I like to call it, and I'm basically a 6-year overnight success with options trading and with investingwithoptions.com. It's interesting that Wiz is a Navy pilot. I am based out of Destin, Florida. I do not have any military experience, but every single person in my family does. So we're at Eglin. We got the F-22s and F-35s flying over basically every single day. It's a little rainy and thundery.
That's awesome.
Here today. Yeah, it's really cool.
Yeah, great base.
Yeah, it's really nice out here.
Yeah, I visited. Isn't there a museum somewhere around there? I visited that museum about a year ago.
There's an air armament museum out there, and then you've got, just a little further down, you got Pensacola at the Naval Air Station. They've got some other stuff out there.
Yeah, cool stuff. All right. Well, let's go back to you, Matthew. Based on any technical fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week, and that's the close of Friday the 17th?
I think it's going to move slightly higher. The bias is just slightly, ever so slightly to the upside. We're coming into earnings season, and I really think that we're going to chop, but the bias is to the upside. I mean, absent just in a horrible geopolitical or macroeconomic event, the bias is to the upside. I mean, the liquidity provided by the Fed, the zero interest rates, it's just, we're going up. I did a weekly options live trade brief this morning, and we put on some weekly options. I like trading the SPX over the SPY, just a little different tax treatment, but we put on an iron condor because I think we're going to chop around, but I definitely think the bias is to the upside. The soft rally that we're seeing over in China is just crazy. Otherwise, I'd say, watch the Chinese industrial production and GDP numbers tomorrow night. That would be the only thing that, if that imploded for whatever reason, that I would think would bring us down. But you can't. You got to either get on board that train in China or get out of the way, because just taking a look at the FXI is nuts. So I think we go up. I think we stay below 2020 by Friday though on SPX.
Okay, cool. And well, I agree with you on the China thing. The biggest winner I have today in portfolio, I'm just looking at it now, is JMEI, and it's up about 8%. And it looks like at this point you could just throw a dart at China based on the FXI. I love bubbles. Someday it's going to end. They always end, but in the meantime, you can make a lot of money. Based on your confidence level, rate your confidence, I should say, in your answer to question 2 on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confident. And let me just remind you that the question's a little tricky. 0 means 50-50, means it could go either way, and 10 means you're 100% sure. So kind of start your scale at 50-50 and go from there. Does that make sense?
That the market's going to go up?
No. Rate your question. The next question is rate your confidence on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confident. You swear it's my first show. Go ahead.
I would say I'm a 9. I'm a 9 delta
Wow.
on that.
All right, I like that. I like that. Man, conviction. Okay, Norm.
Well, if
Same
I
question.
yeah, if I didn't, I would have put on that trade. So that's why
Yeah, put your money where your mouth is.
you
That's
never
cool.
squeeze the trigger on real capital or real missile for that matter, unless you're pretty damn certain it's going to work.
Yeah, what I like to say when I talk about trading psychology is I've never met an unsuccessful paper trader. So amen on that. Okay, Norm, let's
Correct.
go to you. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower next week? And then once you give us your opinion, rate your confidence to that answer on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confident.
Okay, I think I'm looking for a pullback this week.
Okay.
Did you mean by next week? Do you mean this week?
No, the close of Friday, the 17th.
Yeah, well, that would be this week. Okay.
Yeah.
So I'm looking for a pullback this week, and I have a major change in trend window due at the end of this week. So we get a pullback, and the bigger the pullback, the bigger the potential reversal I'm expecting by either Friday or Monday. If we get a sharp pullback into the weekend, then I'm looking for a big reversal to the upside into the end of the month. And my confidence level on that would be somewhere between 8 and 9.
Okay, we'll go with 8.5 then.
8.
Yeah, the report the report comes out before this week starts. Then, so that's sometimes I say this week, next week when I mean this week. All right, Steve, you know the routine. Up to you next. Based on any technical fundamental indicators you want to use, would you predict that the P's will move higher or lower by the end of this week, and that's the close of April 17th? And then once you give me your answer, go ahead and rate your confidence on a scale of 0 to 10.
Sure. Remember, with technical indicators, pattern rejection is just as important as pattern fulfillment. So last week we had a very clear level of support on the S&P right around 2050. It had been tested once, twice, maybe 3 times. I've got lightning behind me, so if I lose power, I'm sorry.
Yeah.
2050 was tested 3 times, and we had that really ugly move on Friday during Good Friday when the markets were closed, and it looked like, okay, we're going to gap down, we're going to see some follow-through, we're going to break support, test a 200-day moving average, and then it didn't happen. There aren't any sellers right now. There aren't convicted sellers, and the longer we go in this range without those sellers coming in, eventually that range will resolve in the context of the uptrend.
Amen.
Now we've got very obvious resistance levels on the S&P right around 2120. When we see obvious levels like that, it often acts as a magnet where the market will want to test that level to see if those sellers will step up again. Combine all of that with the fact that the market during the past 2 weeks was in a trading range between 2050 and 2085 and didn't go anywhere. We are due for volatility expansion, most likely in the context of the trend. And one more piece of data, and this is pretty cool. You know, quantitative studies can be a lot of cherry picking, a lot of curve fitting, but this was shared with me today. The performance of the S&P 5 days after the tax date, the tax deadline, which is normally April 15th. Sometimes it's later because it's a weekend. Since 1995, it's a win rate of 85%, average percent return of about 1.5%. So there is some bullish seasonality going on with respect to tax season. The stock market has been in some big, dumb, ugly, stupid trading range. Domestic stocks specifically, China's been running hot. But I think that we are most likely going to head higher. I'm wrong if we lose 2075, and I think 2120 is going to act as a magnet. My confidence interval on this is about a 7, simply because we've sold off in the very short term as soon as I started talking about this. So that's how it goes.
Yeah, that's how it goes too. Well, number one, everything you just said. So thanks for stealing all my thunder. Speaking of thunder, we're in the same storm you're in, I think. So we could have some fireworks here too. I'm going to go ahead. Let me give him a prediction first, and I'll back it up. First of all, I'm going to go ahead and predict higher, and I'm going to give that about a 7, or I'll give it a 7 just for the record. one thing that's kind of interesting, and maybe I can elaborate a little bit more when we get to the next question, is it always amazes me how simple techniques could work, especially when a market is in a trend. And we've been in a trend for the past several years, as you know. It's kind of interesting. You go back to 2012, the S&P is up 70-something %. And during that time, we've had daylight above the 200-day moving average. By daylight, I mean the low is greater than the moving average in all but 9 days, if I counted correctly this morning before I wrote my column. So just by staying on the side of the moving average, staying on the side of daylight, meaning that the lows are greater than the moving average, would have kept you in for the majority of that rally, and you would only been out a few days of that entire rally. Now, I don't suggest you rush out and trade this mechanically, but simple things can keep you on the right side of the market. It amazes me how many people like to fight the trends. And it's been said that trends exist as long as people fight them. And I'll elaborate on some of these things when we get to the next question. So I'm going to go with up with a confidence of 7. I think I pretty much agreed to everything with Steve. So yeah, I'm going to steal your answer on that one. Okay, let's go to the next question.
Dave, mind if I jump in?
Go ahead, please.
I just want to follow up to the previous comment on the 2120 neighborhood. I have in that same neighborhood, I have 2138. The reason for that is that if you take the high back in 2007 and the drop into the low on March the 6th, 2009, you take that range for the S&P, I think it's 910 points. If you multiply that times 1.618, that's the Fibonacci ratio, and add that to the low of 666, I think you get 2138.
Cool. Well, you're up to. Go ahead and while we have you, go ahead and finish the answer to the question. What developing events, they can be technical or fundamental, will you be watching out for this week that ends on the 17th that might have a positive or negative impact on the S&P 500 and other U.S. markets?
I just same thing I said before. The only thing I care about the news is that there's some announcement or something might affect the news, might affect the market temporarily. I don't even really think that the news affects the market. I think it's more the other way around. The play's the same, only the players change. I think there are cycles out there that makes the markets changes people's psychology. How many times do you see the same news come out on a Tuesday, for example, and then 2 days later and that's considered positive, the market goes up, then they repackage or recycle the same news item 2 days later and the market goes down. So how valuable is the news,
Amen to that.
It's more importantly what people's mood, the mass mood is, and how people interpret that news at that given moment. Now, the fact that they release a news item at a particular time, that's I want to know about that just as an avoidance. I want to get out of the way, if there's a train coming, but other than that, I'm not going to trade on the news. I'm going to trade on my technicals and my cycles.
Amen. Yeah, I fully agree. It's not the news in and of itself. It's a reaction to the news. In fact, I think if you wanted to trade news, maybe just fade the news. And if you just watch some of these news events, like I was asked at a seminar a while back, what's going to happen when Mr. Jobs dies, unfortunately. And I said, well, you watch the stock, and then the day after the reaction, whatever that close is, when it comes back through that close, if it goes down, buy the stock. And that played out fairly nicely now. So, again, it's not the news in and of itself, but the reaction. Matthew, let's go to you. Same question. What developing events, technical, fundamental, will you be watching out for this week that might have a positive, negative impact on the S&P 500 and other U.S. markets?
Well, I like like I said, I have a weekly iron condor on. I like the resistance at 2120, but I got to be honest with you, man. We're still in bizarro market where good news is good news. Bad news is good news, and awful great news. So in non-bizarro market, before the Fed decided to get involved in capitalism, I'd say retail sales tomorrow, core retail sales tomorrow, and regular retail sales. I would have said China tomorrow night. Wednesday, we got an ECB meeting that that they're maybe doing their tapering with Mario Draghi. I would have thought that might ripple across the Atlantic. Thursday, we get a Philly Fed and building permits, and then Friday, University of Michigan consumer sentiment and also some CPI, some inflation numbers. So, to be honest with you,
I think we just lost him.
Yeah. His maid must have got a hold of him. All right, we'll come back to you, Matthew. Steve, while we have you here on the floor, what developing events, and they can be technical, fundamental, what have you been watching out for this week that might have a positive, negative impact on the S&P 500 and other U.S. markets? Not got the giggles.
Earnings, basically. When you're looking at the bearish narrative that gets put forth, it always sounds more fun and more smart than the bullish narrative. Bullish narrative is, oh, prices going higher and so on. There's always some sort of cute way to say, okay, these are going to be the key fundamental reasons why the market's rolling over. So, we had Ukraine in October. We had the Federal Reserve interest rate hike that it's not necessarily causing the market to go lower, but it's sort of an injection in fear. Right now, there's not a whole lot of fear going on in the market, but the narrative that's been put forth is this phrase called earnings recession. And that is related to the amount that corporations as a whole earn and whether or not that money, that number is growing or shrinking. And 2 consecutive quarters of earnings per share shrinkage from corporations is an earnings recession. And that tends to lead to downside action. But what I'm thinking here is those that wanted to sell into earnings have already sold, or those that needed to hedge have already hedged. And so we're going to head into earnings season here, and we're running really we've got a really nice setup on the S&P where it has been range bound for 2 months, and we've got earnings, and there could potentially be some fundamental catalysts. So look at those big bellwethers, especially in the S&P, that are up on deck. I think J.P. Morgan and a lot of the financials are up this week, so that's probably going to be the potential for a catalyst, and we'll see whether or not the current price levels are justified relative to the actual fundamentals. We're going to see a collision between the expectation and the reality of these companies. It's probably going higher simply because the trend's up. So, but that's what I'm watching for.
Earnings recession, they always come up with a new term. Isn't that great? That's kind of interesting. Matthew, we lost you for a second. I guess you and the maid got together or something. I don't know what's going on.
Exactly.
I don't want to know. But remember, your camera was on. Anyway, did you get to close the loop on your thoughts? The last few seconds, we got cut off.
Yeah, you bet. So, like I was saying, a lot of those macroeconomic events that I laid out used to be drivers of the market, but I think, and Steve's right when we're talking about some of the earnings in the financial stocks. I think unless you see just absolute swings and misses out of the financial earnings, that'll be the driver of the market. I think obviously the strong dollar is going to impact a lot of multinational companies. That's why I've also been taking a look at the Russell around earnings, because obviously a lot of those companies in Russell aren't too concerned about a strong overseas dollar. But yeah, Bank of America, Wells Fargo, I think J.P. Morgan, financials and transports tend to lead us in and out of badness, so to speak. They're kind of the canaries in the coal mine, and if those things are rolling over, that might set the tone for the rest of earnings season. But I think, unfortunately, a lot of these macroeconomic events, even as Steve talked about a couple of weeks ago, that job, thank God the market was closed on Good Friday, because we had the weekend to think about it and go, you know what, that horrible jobs report is actually great news, because now Janet's not going to do anything until the fall, or even here in 2016 now. So even if, other than that, Mrs. Lincoln, how was the play? Even if earnings are kind of crappy this week, I think we just melt up. It's just you can't fight the tape, and you can't fight the Fed.
Amen. Amen on both of those. I was something just to kind of dovetail in on something Steve said. For some reason, we're together today. But I like what you said about it's always worse. It always seems worse than it actually is. And it's always painted worse than it is. I don't remember the gentleman's name. He was a Swede, but I was on a long international flight about a month or so ago, and I was watching a TED Talk, one of the shorter TED Talks, and this guy gives this test. It's like a world test of like world knowledge, and he gave some little hints on how to pass the test. And one thing that he said, which is fascinating, is that it's always worst. It always seems worse than it really is, because the picture the media paints this picture like everything is horrible, the world's coming unglued, and so on and so forth. And I think a lot of that happens in the markets. And yeah, you could make a logical case to rip off Steve's comment earlier. You could make a logical case as to why the market is headed lower, but in reality is, so far, it's headed higher. So err on the side of the trend is what I tell everyone. The other little thing that I've been really paying attention to, something really simple, is as long as the market is at or near new highs, then you want to err on the side of the trend too. Even though we've been a little range bound in here, the S&P is only about 0.5%, maybe a little bit more today, maybe 0.75% now, away from all-time highs. The Russell 2000 was 0.25% coming into the day away from all-time highs. So as a general statement, err on the side of the trend, we've kept our positions open, even though the market was kind of rolling over a while back, because we simply followed a plan. And luckily, some of those are up 40 and 50% since then. If we'd have bailed out on everything at the first sign of adversity, we'd be bummed out right now. The only other thing I want to bring up, too, is as long as the market is in a trend, simple methods will work. I know that's a big if. But, again, if you take a look at the S&P 500, if you get a chance, plot the 200-day moving average. Just a simple moving average is all you need to do. And like I said, we only spent about 9 days below it, meaning the highs are below the moving average. We only had 9 days of daylight below it over the last 3 years. And doing that run, again, to reiterate, the market is going up about 75%. So keep it simple and err on the side of the trend. Let everybody else pick the tops. And then the only other thing that's kind of a random thought coming to my head is it seems that anytime this market has the slightest of spills, all of the bears come out of the woodwork. And us guys that have the educational business, such as some of us here today, we have an advantage because we get emails from clients telling us how it's the end of the world, and we get to see what's going on out there. And as long as that fear is out there, I think this market's going to continue to go higher. So that's a little tough to quantify. It's more of a gut feel thing. But again, if the market is close to new highs and if it's well above its moving average, it's been there for a long time, then err on the side of the trend. And that's why every week in these shows, I just say up as long as those two simple things remain intact. And I don't know what my record is, but I'd be willing to bet that I've been right more than I'm wrong, since the market has probably gone up significantly since we started these shows. Anyway, let's go to the last question. Let's see who's up next. I think Matthew, you're up next. What asset type, stocks, options, forex, futures, do you think is the easiest to trade profitably, and why do you think that type is the easiest?
I'm obviously going to be a little bit biased here. Equity options. Yeah, unless it's for hedging, being delta neutral or some other tactics, I haven't traded a stock in over 20 years because in my opinion, there's really no reason to. Why buy the cow when you get the milk for free is kind of my motto. Because the average buy and hold's dead. This isn't your father's stock market where you buy shares of GM, literally put them in a shoebox and in the closet and forget about them. The average holding period is last survey I saw was about 5.2 months, 4 to 6 months on average. So I like equity options. Unfortunately, people have kind of been scared out of them. They're either complex or anything like that. So that's why at Top Gun Options I try and break it down to, okay, the absolute blocking and tackling and the basics. But in a market like this, where uncertainty is reigning, talk about uncertainty with the VIX down here at 12. Well, it was 12.51 the other day, and we broke 13. I think we're hovering around 13 right now. I'd be getting long vol like you read about right now, because we all know storms are coming and the music's going to stop, and you want to make sure you have a chair, right? So when vol's cheap, you buy it. When it's expensive, you sell it. So I'd be looking to get long the VIX here. But I'm an equity options guy. Always have, always will be. If people do trade stocks and they know about options, maybe they do covered calls. Well, Steve and I and other options traders can show you tactics such as a cash secured put that's got the same exact risk profile as a covered call. So I'm an equity options guy. Haven't traded stock, and I can't remember the last time I traded stock. So but I'm a little biased, obviously.
Gotcha. Well, I'm gonna be biased towards the individual equities, and I'll talk about that when we have my turn. We may finally have some controversy on the show. Before that, let's go to you, Norm. What asset type, and it can be stocks, options, futures, forex, whatever you want, do you think is easiest to trade profitably, and why do you think that type is easiest?
Okay, if you don't mind, I'd like to diverge just a minute and go back to the earlier question and kind of pull a little bit of this question in too, in that I just remembered what's something interesting going on in the markets right now is the dollar. You have your dollar index, and the dollar you had back in 2001 a major top in the 120 area on the dollar index. Then it dropped to a few years ago. I think it got to about 77 and change, and now we have now retraced almost 0.618, the Fibonacci retracement of that entire decline. We got about a month ago, got within about 99 cents of my magic number there, which is about 101.37, and we're now reapproaching that level again. So that could be that's a major inflection point, major resistance point. If we get over that level, then that would imply that the dollar could go another almost 20% higher. That could have major ramifications for all the markets. It could even, maybe you could argue that could have some recessionary, depressionary. No, I don't want to use depressionary, but great dampening effect on the U.S. economy because our relative currency value to other countries, we would probably lose a lot of trade with that high of a dollar. So there's something just to think about, something to keep your eye on. My letter covers about 30 markets. I use the cycles to determine which markets are going to be the most active markets for the month. At the top of my list, I remember I had stock market, I have bonds, I had corn. So you'd have to kind of get my letter, or you can get a free copy of my letter just by contacting me. I have a free class, 2-hour class that goes with the letter, and you're going to learn some advanced technical analysis. It'll also show you the different markets I cover. Let me address Matthew's point there about trading stocks. I originally was a CBO market maker, traded in the individual stocks and stock options. I haven't done that for many years. I think it's probably about the same as Matthew. They're probably 20 years or more. And the statistics support that approach. It's sort of who's the guy that founded Vanguard? It's on CNBC every now and then. John Vogel is that his name. He also makes this point. 50% of all individual stock price behavior is attributable to the general market trend. Another 30% is the end industry or sector that company is in. Therefore, for all your hard work in trying to pick the magic stock, you're only down to a 20% factor for all that hard work, and now you've taken on additional risk. It's called individual security risk by picking one stock. You pick one stock, then they come out and they say, oh, sorry, we messed up on our earnings and we have to revise them down, and then the stock gaps down and you get a big whack. If you trade the indices like the S&P 500, and some stock does that, it's just a drop in the bucket. It's a nothing. So it's actually lower risk and smarter to trade the indices than it is individual stocks.
Okay, well, we finally get a little controversy on the show. I'm going to take the complete opposite of everything you said, but hey, you know what? That's what makes the market. And just hang tight for a second, Norm, and we can revisit this and maybe go back and forth a little. Steve, I have no idea what you're going to trade because your website is investingwithoptions.com, but tell us anyway.
Well, the running joke is my website should have been tradingwhateverwecangetourhands.com, but that's how it goes. So the question is, what's the easiest asset to trade profitably, correct? That's
no, well, okay, what asset type do you think is easiest to trade profitably, and why do you think that type is the easiest?
Okay, I'm going to sidestep it and say that this question's a little misleading because it's not just about the asset.
Are you in politics?
It's not just about the asset. It's about the liquidity dynamics of the asset. So, for the most part, individual stocks and trading individual stocks it's not a good bet. But there are instances, because you have the high frequency traders and you have the intermarket risk and you have the correlation risk and everything. But there are certain instances in which the liquidity dynamic shifts and the stock becomes in play. That's when you see proper technical patterns work. So, for example, GE just announced some stuff that they're spinning off, GE Capital. If you look at the price action over the past 6 months, it's basically random. It's a stochastic process. It's basically following the market. But then news comes in, and now it's in play. And on a very short-term basis, there are individual setups within that you can play. It's on a much shorter time frame. Now, with the question being, trading profitably in which asset and everything, that also is a little misleading because it really does depend on the individual investor and what your risk tolerance is. Some people like day trading and scalping futures and Forex. That's really hard. Some people like trying to hold on for the total meat of the trend. That's hard for me as well. My wheelhouse is a time frame between 2 weeks and 2 months, looking at very specific setups on individual stocks and using options. I'm a big fan of options, especially for new traders in general, because your goal as a new trader is not to become a winning trader, it's to become a break-even trader first. And most traders don't get to that break-even level first. And the way to get to break-even is to make sure that your losses don't blow out your account. And one of the ways to limit your losses is to use options. And so that's one of the big advantages to stock options trading, is that when you screw up, you will not screw up as big. You could take Dave's kinds of setups with trend following and everything, but if you don't have the right psychology, you're not going to cut your losses short because you'll say, oh, it'll just turn around whenever, and then you're going to blow out your account. And that's one of the advantages with embedding the risk already into your options trade. So I'm done preaching for now.
No, it sounds good. +1 on the psychology issue. I talk a lot about that. I write a lot about that and do a lot of webinars and seminars and such on that. So amen to that. And a lot of times people do the wrong thing and they know they're doing them. I actually have a free report. I could put a link on my website for that if you're interested. It was an article that came out in Traders Magazine about a year ago. Earlier I kind of joked about having a little controversy. It's not my way or the highway, so I know that that's what makes a market trade would make sense to you. Now, I think it was Norm pointed out that it's a lot of hard work to trade individual stocks. It's a tremendous amount of hard work. I go through 2,000 to 3,000 stocks a day. On Amazon, one of my not-so-great reviews was the fact that it's too much work. And it's like, I think anything worthwhile is worth working hard at. A lot of people, Norm kind of mentioned the proverbial black swan that you want to try to avoid, and we actually go out and look for the black swan. I actually did a column a couple of weeks ago called Black Swan Hunting. We're looking to play that outlier, and we're looking for an inefficiency. Speaking of inefficiency, I have another article that should be out in Traders soon. It's the cover story. It's either on I think it's already out in Germany, but it should be out in English soon. And if you go to my website and if you go to the store and click on free reports, there's a 21-page report that you'll get automatically delivered on my methodology. And then what I'll do is I'll send you the inefficiency article when it comes out. The reason I wrote about inefficiency is because if you're going to make a lot of money in the market, you have to capture a trend, and the best trends are going to occur in inefficient issues. Now, I know we got some option guys here today. I'm kind of overloaded with option guys this week, but you can maybe use your options to play those particular issues. Now, to give you an example, we got in JMEI, that's a China stock, a few days ago, and now we're up about 20%, knock on wood. We got it to an IPO, TRIL, a few weeks back or a few months back, and now we're up about 100%. Those type of moves aren't going to happen in the overall market. They're too efficient. There's too many people fighting it out. Now, you can trade an efficient market like Forex. Just pick your spots carefully. You can consider your hands more than anything, and because there's only a few currencies, obviously, that are liquid enough to trade. I go through my entire tradable universe of about 2,500 stocks every night, and I look at nearly every one of those stocks I also go through 250 sectors, and then I look at all indices and some ETFs. And by the time I'm done with that, it is 2 to 3 hours of work, but it gives me a really good feel for what's going on in the markets. And I don't want to pontificate too much here, but the thing is, I think if you want to get better at reading charts, you need to look at a lot of charts. And I think doing that over the years has given me a really good feel for the market. As far as, I know Norm says that you can get those black swan moves, you can get whacked. I fully agree with him. However, surprises usually happen in the direction of the trend. So a lot of times these big moves, just like that 100% move I mentioned earlier, that so far has been in our favor. Again, knock on wood. But what you have to do is, number one, you have to take a small position size on any given trade. And for me, that's 2% if stopped out. And number two, you take partial profits, because you can only predict the short term when it comes to the markets. I hear it's thundering over there where Steve is. I bet it's going to be raining pretty soon, too, if it's not raining already. But we don't know if it's going to be raining this time next week. But, of course, with all the rain we had lately, it probably will be. But the point is that only short-term forecasts are viable when it comes to markets. So, but you can stick with the position as long as it moves in your favor. I think Matthew was pointing out that the average hold time is only 4 or 5 months, and it's probably less than that. But here's the deal. If you get into a position and it moves in your favor through a trailing stop, you can stay with that stock as long as you want. I'm slotted as a swing trader. My first 2 books have the word swing trader in the title, swing trading in the title. But we'll stay with positions sometimes 2 or 3 years, or as long as they move in our favor. So if somebody asks what my holding time is, my answer is hopefully 2 to 3 years, or maybe 10 years or longer. Anyway, I didn't mean to go off on a rant, but that's pretty much my whole methodology in a nutshell. I think you're better off trying to find inefficiencies in markets, and for me, that's stocks. But to each its own. I like going on that treasure hunt every night. I like getting a big cup of coffee and going through all those stocks, and I find it kind of fascinating. So, again, not my way or the highway. All right. Sorry about the rant.
I want to hop in real quick.
Go ahead, Steve.
I don't agree with going through 2,000 stocks a night. I think that there has to be some kind of screener ahead of time. Otherwise, you just end up looking at noise. So, that's just my approach. For example, you're looking at in-play stocks. You look at stocks that maybe saw 3 times their average true range to the upside on increased volume, and then you drill down and look at those individual patterns. Because if you're looking at something, we can use our GE example. There's not going to be a proper pattern in GE over the past 6 months because it's been random noise. So I'm a big fan of using some kind of screener to get the signal out and then looking at the charts to get the patterns. That makes sense.
Well, I'm doing some screening in that I'm filtering. I'm only looking at my tradable universe, which has volume of, I forget what my filter is right now. 250,000 right now. But that's still a few thousand stocks. But something like GE, I wouldn't even look at because the volatility is so low. I'm sorting by volatility. The other thing I'm doing too is, first thing I do is I'm looking at new highs. So I go through the first 100 or 200 stocks, see what's making new highs. And if there's something I really like, I put it off into a momentum list that I call my Landry 100. So I am doing some filtering by doing that. And then after I look at those stocks, I look at them again in that I run a very loose parameter scan, and I'm sorting them by volatility first, and then the secondary sort is by anything that's pulling back. So by the time I do all this, I have gone through several thousand charts, sometimes twice. But it's what I enjoy doing. So to each his own. Now, I'm not sitting there and agonizing over a chart. If I see a chart like GE, it looks like an electrocardiogram, I hit my spacebar really quick, and I'm off to the next chart. I only slow down if there's something that looks really interesting, something that's in a strong trend, something that's maybe set up as a bow tie, which is one of my tradable patterns, or one of my other patterns, and then move on. So, yeah, when you first start doing it, it all looks like a lot of noise and no signal, but after a while, you're going to find that the best setups will jump out at you. Again, to each his own, but I agree with a lot of things you guys said today, but I also think that your big opportunity is in that treasure hunt, but it does take a while to be able to look through 2,000 stocks, like Steve said, and separate the signal from the noise.
Dave,
okay,
can I
anybody
jump
else want to chat? Yeah, absolutely. Come on.
This is Norm.
Hey,
Just
Norm.
want to connect the dots on what I said before. 50% of all individual stock price behavior. By the way, I first read this back in the late 80s in the Wall Street Journal. It was a Goldman Sachs Commission academic research. 50% of all individual stock price behavior attributable to general market, 30% industrial sector that stock is in. What this means is that for you to be successful, you might be the exception, Dave, but for most people to be successful trading individual stocks, you still have to know where the market's going. Now you're taking additional risk by picking one stock, rather than doing all that extra work and not having a life. You need a super big cup of coffee, I guess, Dave, right?
Yeah.
For picking all those stocks. You still have to know where the market's going. If you can forecast where the market's going, then you don't need to pick the individual stocks. You can make money trading the stock indices, the futures, the options, or whatever you want. Just trading the indices. You don't have to hit a home run. Be like Pete Rose and hit singles. If you hit enough singles and doubles, you're going to have home runs. It all adds up.
Well, I'm not going to argue with you on the 50% and 30% for the stock market and sector respectively. But if you use something simple like I said earlier, moving average, or I'm called the trend following moron, so just draw a big arrow in your charts, and that's how I got that name years ago. And if that arrow's pointing higher, then you definitely want to be on the long side, and then ideally you want the sector to agree with what you're seeing in the individual stock. And I think there are some tradable patterns, or I know there are some tradable patterns, and if you could find these patterns, and they're not that difficult, you could do quite well in individual issues. But again, I like what Steve said too. You have to separate the signal from the noise, and that comes with a little bit of experience, but the patterns aren't that difficult. And the other thing too, something simple like waiting for an entry. We had a lot of shorts show up over the past several weeks to several months. One client called me up, or actually emailed me over the weekend. He said he lost a lot of money in those shorts. Well, I went back and looked at them, and none of them really triggered. So it's like, well, first of all, I didn't recommend any directly, and then none of them actually triggered, even if I would have recommended them. So something simple like waiting for an entry, meaning that that market confirms what you're seeing, can often keep you out of a bad trade. It's amazing how these simple techniques can work. Matthew, you're being kind of quiet over there. You got anything to say?
No, I'm listening. I'm taking it all in. I'm at the buffet right now. I think I agree with a little bit of everybody, to be honest with you. So no, that was all very, very good. I agree. Like I said, I'm going to go. You call Steve a politician. I'm running for president apparently today because I agree in some respects with everybody, to be honest with you.
I think that cute maid is distracting you.
Exactly.
Okay, well look, we stirred it up a little today. Oh, somebody's coming in. Norm,
yes, sir. I just want to add. I think there's a lifestyle decision here. I made a lifestyle decision about 20 years ago. When I first started on the CBOE, it was a child of the Board of Trade. It was housed in the Board of Trade building. I ended up meeting a lot of some of the best traders in the world. Like I knew the O'Connor brothers, who started out as, they grew up on the poor kids on the south side of Chicago. I think their father was a cop. They got jobs as runners, and by the time I met them, they were multimillionaires. These were guys who were on the Board of Trade, and so I met a lot of great commodity traders, and looked at my world, the CBOE world there, where back then in the 70s and 80s, you had 7,000 or 8,000 issues. And now it's double that. And my commodity friends were going, the whole world is only 30 markets. And I think about their world of only 30 markets and thinking about 8,000 issues and plus 20 or 30 options on every stock. I think about that and I get a headache, and then I think about, oh, their whole world is 30 markets. That sounds pretty good to me. Maybe I'd call me lazy, but I kind of like that world where you only have to look at 30 markets.
I hear you. But that brings us straight back to efficiency and inefficiency. We had a solar stock. Now I know it's an outlier, but we're going for the outliers. We had a solar stock go up 600% over a year and a half. That's not going to happen in corn or soybeans, or that might happen in some of those markets. But as a general statement, the stock market's not going to do that, and most of these efficient markets, our currency's not going to do that either. So I think if you work hard, you can find them. But again, to each its own. You guys are big fans of options. I think most everybody here. That maybe use options to play some of these type of things. Matthew, looks like you wanted to chime in with something.
Well, no, I was just going to say, Yeah, to maybe put a bow on this topic, I teach my traders to Top Gun options at various skill levels. Just starting out in primary, maybe you have 5 stocks or indices that you follow and know like the back of your hand. Intermediate, once you start getting a little comfortable, maybe 10 positions. But at max, even at a professional level, in the portfolios I manage here at Top Gun options, I have no more than 15 positions, because other than that, man, I mean, that now it is like herding cats. I want to have situational awareness into just about every one of those things that's going on. And really, I like drilling down into specific stocks occasionally, whether it's Apple or Twitter, Google, some of the tech stocks, because they're their own stock market. I mean, hell, they have their own volatility index. Some of these, there are people out there that don't even know a stock market exists, and because all they trade is Apple. But I like trading a lot of the indices. Just for that reason as well, that Norm was talking about, that you're instead of picking one energy stock and hoping NOV does better than ConocoPhillips, why don't you trade the XLE? I think Wells Fargo is going to crush it and JP Morgan isn't. Well, why don't you trade the XLF? So 5, 10, 15 is the skill levels that I put out at Top Gun options. So just starting out, 5 stocks or ETFs that you really, really want to get to know. Then 10, and then no more than 15.
Okay. The last segment of the show is usually closing thoughts. So sounds like you kind of wrapped that up. You have any other closing thoughts you want to add to that?
No, just the final thing, like I said, is you want to be flying around this market with an ejection seat, man. I never flew in any combat situation or off the aircraft carrier without an ejection seat. So if on a day, if you have a day where the market's up 100 or down 100, and you have all green or all red, you're just trading wrong. I call it a Christmas tree. Your portfolio should look like the control panel of a ballistic missile submarine. I mean, if you're just long and you don't have any VIX or SDS or SH, the ultra or the bearish on the S&Ps, you're just doing it wrong. It's a little bit of insurance that can help you sleep at night. You can never be fully hedged. I mean, it's impossible. It's like, I don't want my kids to get hurt. Well, what are you going to do? Wrap them in bubble wrap and lock them in the room their whole life? You can't. There's got to be some risk.
Yeah.
But this is not the market to not be hedged, because it's not a matter of if, but when she raises interest rates. And as you guys all know, when interest rates are high, stocks will die. When interest rates are low, stocks will grow. So get ready for the storm that's a-coming. I can't predict when it's going to be, or my call sign would be Nostradamus and not Wiz, but it's a-coming, and just make sure you have an ejection seat and you're safe for when that day comes. And as an options trader, I plan on pounding the hell of the market once it turns and goes lower to the downside. That's the beauty of options.
Amen. And I was at a webinar a couple nights ago, and it came up the fact that when did the Fed turn from being, I don't know what the word is, maybe prudent and just controlling interest rates as they need to be controlled, or kind of nudging them along. When did they turn from that to our job is to do whatever it takes to make stocks go as high as they can? And I think they've kind of painted themselves in a corner, and they're losing some credibility now. So
Correct.
That's what's kind of scary. It used to be years and years ago, you're like, come on, give us a quarter point, give us something, throw us a bone. And when they would, the market would take off. It was great. But now it's just this QE infinity or whatever they're doing now. I try to avoid the news.
Yep.
Anyway, Norm, you have any closing thoughts before we wrap things up today?
I would just like to pick up on Matthew's philosophy there, grouping the risk rather than picking an individual stock. You go with an ETF, although I think the ETF world, you have to know that very well, because there's maybe only 5 or 10% of the ETFs that are worthwhile. It's a minefield out there. Just a real quick story back during when the crude oil topped at 147, I think that was in '08. I read I started watching. I got the idea. I was doing futures, but I thought it'd be interesting to watch the reverse ETF, inverse ETF on the crude oil, thinking that if it topped out there, you can make a ton of money. And then it got written up a few months, about 8 months later, how crude oil had dropped from 147 to 33, and people bought that. I forget, is that the DUG? Maybe Matthew knows. I think that's the DUG, is the inverse crude oil ETF. So it's supposed to go up when the crude oil goes down, and people did that and actually lost money, because it was like buying an option, and there's huge slippage there. And so these people were right about the market and wrong about the vehicle.
Well, inverse ETFs are flawed anyway, so I mean you can't really use that as an argument. But I hear what you're saying. I mean, there's always there's 50 ways to lose your money. But yeah, adverse ETFs are just flawed. In fact, if you want to start a hedge fund, just start a hedge fund and short them all, and you'd probably do okay. And that's because the tracking error is abysmal. There's not enough time to get into the math, but that's. I disagree with you on that example, but hey, we got some controversy, David.
All right. I want to throw out real quick what I think is a better vehicle and a way you can save on taxes. Futures and options come under a different part of the tax code. It's section 1256. It's called 60/40. You get immediate if you make a profit, immediately you get 60% of that goes to long-term capital gains. That's currently capped, and if you're under 400,000 a year, at 15%. If you make over 400, I think you're at 20%. You're going to get a lower blended rate to do the futures or options on the futures versus all these ETFs. So, there's a little wrinkle there in, for example, for gold, GLD ETF, that's one of the better ETFs, but you can do that and you get, the IRS treats you just like you went out and bought gold bullion. That gets you under what's called the collector's tax, that's 28%, or you could go do the gold futures or gold options that are on the futures, and then you're going to get the 60/40, you're still going to get a lower blended rate. So there's a little wrinkle in the tax code there.
Okay, Steve, let's go to you. Any closing thoughts
Sure.
or anything else you want to tell us about your website, investingwithoptions.com?
Yeah, I'll do my pitch here. If you're interested in learning about options, both trading directionally and trading for income, I've got a premium trading service, got video training, all sorts of things. It's awesome. I'd love to have you check out investingwithoptions.com. Ton of free content out there. Two final notes. First off, Dave, you said that inverse ETFs are flawed. I completely disagree with that. The exchange-traded products out there trade and behave exactly like they're designed in the prospectus.
Okay, okay, you're right. They track the day-over-day change, which does not work for a longer-term trader. So, okay, all right.
This is a huge sticking point for me because a lot of investors think they can get cute with volatility exchange-traded products, things like the VXX and UVXY. And then the market sells off, the VIX pops, and then they don't make any money, and they say, I got screwed, this instrument's terrible. But if you actually go and read the prospectus, for example, in the VXX, which I'm pretty sure is trading like crap today.
It's based on futures, right?
Yeah, it's based off of volatility futures, not the spot VIX. You can't actually get long the VIX. It's impossible to do. Right. You can only trade VIX futures, or you can trade the VIX options, which are based on the VIX futures, which have completely different things. So that's one thing that I'd like to point out.
Okay. No, I hear you on that. And I hear, they're not, I guess flawed is a bad word. They do what they're supposed to do, but it creates a horrible the end result is a horrible tracking error, which actually which pointed out, I think, by Matt to begin with. The only closing thoughts I have is we finally had a little controversy today. I'm a big fan of individual stocks. The actual portfolio, if you go to my website, DaveLandry.com, I took a snapshot this morning and I put it in my column. Now, I feel like I need to be like a dieter's ad. Results not typical, but certainly possible. And you'll look at that, and I'm just looking at it now. We've got a gains, two at around 20%, one at 50%, one at 100%, one at 8%, 3%, and 4%. All together on those, or individually, I should say. So that's the type of inefficient move I'm looking to capture by going through 2,000 stocks a night. And again, to each its own. I have a blast doing it. I can't believe I get paid doing it through my own trading and through my trading service and being able to publish this this research daily. So if you're interested in that, go to my website, DaveLandry.com. Okay, David Cosmitter, let's turn it back over to you. I want to thank everybody before I do. I want to thank everybody for coming this week. I had a good time this week, so hopefully you guys did too. So it was a lot of fun. Cosmitter, over to you.
Yeah, great show, guys. Thank you. Just want to remind everyone watching to go to TimingResearch.com/reports to download this most recent report or any past reports. And also, sometime this coming week or later in the week or this weekend, before Sunday afternoon, be sure to go to TimingResearch.com/current-survey to fill out the survey for next Sunday's report. And just want to thank all my guests again. Matthew Buckley of TopGunOptions.com. Thanks to you for being here for the first time. And
You bet, man.
Norm Winski of you can find out more about him at normwinski.com. Thanks for being here the first time also. And Stephen Place of investingwithoptions.com. Also, John Netto of the Protein Trader was supposed to be here, but I guess he had some technical problems or something, so we'll try to get him on again in the future. And of course, Dave Landry of DaveLandry.com. Thank you for guest hosting again.
Thank you.
All right, that's it. Thanks, guys.
All right, thank you.
Thanks for having me on.